Investment behavior is a fascinating topic, and the way, and perhaps I suppose the psychology and the science behind it even more so, and the way people invest can either cost or lose the money. And I think the latter is probably more pertinent in most cases because people invariably make decisions at the wrong time. So I've got Paul Nixon here with me today, who's the head of behavioral finance at Momentum Investments, and they've done a recent report on this exact topic. Paul, good afternoon.
Good afternoon, Chris. Thanks for having me. What we did at Momentum Investments was, well, what we do every year actually is we have a look at people's behavior in living annuities and discretionary unit trusts. And we have a look at this concept of a behavior tax, so have people destroyed value or added value, for example, through their investment decisions. And then we use some machine learning and AI in the background as well to see if we can't figure out any patterns in these kinds of behavior. So it'd be great to share some of the results of the report with you. All right, Chris, so let's have a look at some of the results or highlights of this report. So the first slide you can see, I just give us an idea of what the 2022 period that we're looking at, which is round about from October 2021 until October 2022. And that's the time period that we'll be looking at today. So what you can see in the first sort of picture here is just the general behavior of people on the platform. Now, what you can see here is the red mountains that you can see on your screen represent the percentage change in the all-share index, right? So is our market going up? Is the stock market going up or going down? And what you can see in the smaller blue mountains is basically the performance differential that people are switching to, basically. So you can see the first thing that's obvious is that there's a correlation. So when the all-share index increases, that's when the mountain gets bigger. You'll see that there's a blue mountain below it that grows as well, right? So when the all-share index goes up in value, people switch to things with better past performance. When the all-share index goes down, people switch to things with worse past performance. And you can see that there's a very strong relationship here. Why would you switch to something with worse past performance? Well, if you're looking backwards, in a normal market condition, cash would perform worse than equity. So, generally speaking, when people switch to things with worse past performance, they're switching to cash or switching to something that they perceive as safer. So first, very, very interesting sort of graph here is that very strong correlation again between what's happening in the market and what's happening with people's investment decisions. Now, of course, those two things shouldn't necessarily be correlated, right? So you should be only worried about your investment goals. You shouldn't be worried about the market. You should have a long-term view, but we see that that's not actually the case. So 2022 was a period of de-risking, and that was the theme of the year. So people were moving away from stocks, from equity funds, balance funds, property funds. They were moving to cash and fixed income funds. That was basically the story of the period. So how do we see that at Momentum Investments? We have a look at the asset allocation of the fund that the person switched from. We have a look at the asset allocation of the fund that the person switched to, and we see basically there's a difference. Now, how we do this basically is we rate every single fund on the platform. We give an asset allocation rating of 1 for cash type funds and then of 6 for equity type funds. So obviously if you subtract the one from the other and you get a negative result, it means that people are moving towards the cash side of the risk spectrum. And in the diagram on the left there, you can see that because the majority of the blue bars are pointing downwards into a negative space, it means that overwhelmingly people are moving, and actually quite a bit, towards the cash and fixed income side of the risk spectrum. And that was really a dominant behavioral pattern over the year. Now, there's a problem with this, right? So the problem is that what I call this, and why the slide is called behavior tax loading, is that you'll see when our report sort of cuts off at October 2022, you'll see that the all-share index is at about 64,000 points there. And you'll see that there's a purple sort of a white circle with a purple outline there. What happened afterwards was that obviously that we've just broken records, right? Recently, the market has broken records. So what's happening is people have de-risked their portfolios aggressively during the year, but now they're stuck kind of in safe assets, right? So when are they going to get back into the market? That's the big question. And what we normally find, of course, in these cases is that, people will now start trying to get back into the market, but of course they've left the market at 64,000 points. And now they're trying to get back in at 80,000 points. And that really is how the behavior tax gets realized. So behavior tax loading, it's definitely something to watch for the next period as well. I suspect that there's going to be some high levels of behavior tax. Last slide, just something interesting to show here is the decomposition of the different behavioral types on the platform. So we use machine learning techniques basically to identify patterns of behavior on the platform. And we can see, again, 4 very, very clear types of behavior over 2022. We see about a quarter of the population being market timers. So these are the people that switch the most. They switch up and they switch down. What happened was we saw that during this period, there was actually a negative behavior tax for market timers. So we can see that predominantly over the 2022 period, there was a slight amount of value added by investors through the switching behavior, because the de-risking basically, then investors moved away from equity type funds that performed very badly to fixed income and cash type funds, which performed actually also quite badly, but not as badly as equity funds, right? And the lesson here really is that, again, when do people decide to go back into the market? So even though the behavior tax for the period is negative, we're in a period now where switching back into the equity market, for example, is going to reverse all those temporary gains that people have made by getting the timing slightly right during the 2022 period. So market timers, for example, include a negative 0.86% behavior tax. The assertive investor, very interesting type or behavioral pattern here. The only type of investor for 2022 that incurred a behavior tax. So a heavy behavior tax of 4.5% for assertive investors. So this, the type of people who like crypto, private equity, hedge funds, up-risked their portfolios in 2022. That was obviously a very, very, very bad thing to do. 2022 markets obviously were extremely volatile, and those investors paid the heaviest penalty. The anxious investor, 38% of the population, in line with the general story, anxious investors de-risked their portfolios, and we see that they actually added the most amount of value. So they had a minus 3.44% behavior tax for the year. Again, just be aware that this might reverse though as they go back into markets now at much higher levels. And then the avoider, also very interesting, 19% of the population incurring almost a 0% behavior tax. Avoiders are those kind of people, though, that don't like taking risks. So they were already in they were already in assets that weren't that risky to start with, right? So that was really the key there. So their switching behavior didn't de-risk too much because they weren't really assuming much risk to start with. So the avoiders are that kind of type of person that incurs a behavior tax in a different way. They don't incur a big behavior tax from switching money around because they stay, relatively speaking, in assets that aren't risky, but they tend to get stuck in assets that aren't risky for a long period of time, and that really exposes them to an inflation risk. So they pay a behavior tax in a different way in respect of the corrosive effects of inflation over a long period of time. So these are the 4 behavioral patterns that we've seen, and what we're doing now with these machine learning techniques is working to a state where we can predict people's behavior, because we see that these patterns are quite stable, and any stability, the stability in these patterns means that we can start to nudge customers and nudge advisors as well, who have different kinds of client types, to give the right message to the right person at the right time. So yeah, very interesting. I found this report very interesting for the year. Very interesting as well to see the differing types of behavior taxes that different clients are paying for different behaviors. But key message is, for this report, you've left the all share index at 64,000 points. The all share index is now sitting near 80. We hope that clients are not getting back into markets now at this elevated level, because those temporary gains in behavior tax are going to unwind.
Wow, Paul, thank you very much. That is fascinating stuff. Where can people get hold of this report?
Thanks, Chris. I think there will be a link. There will be a link in the article to the full report if you'd like to read all the detail. And see what we're up to at Momentum Investments with the research, but also with the technology that we're developing as well to help people make better decisions.
Brilliant stuff. Paul, thanks for your time. Really look forward to our next chat, and all the best. Take care. We'll chat soon.
Thanks, Chris. Chat soon.
Cheers.